Financial markets are highly volatile amid the Israel-Iran crisis, primarily because investors face significant uncertainty about the conflict, its duration, geographic spread, and its impact on critical global supply chains, especially energy. The sharp escalation of hostilities, including Israeli airstrikes on Iranian nuclear and military sites and Iran's retaliatory missile and drone attacks, has triggered a rapid repricing of risk across markets. Oil prices surged by more than 10% within days due to fears that Iran might disrupt the Strait of Hormuz, a vital choke point through which nearly 20% of the world's oil supply passes, raising concerns about global energy security and inflationary pressures. This surge in oil prices feeds into broader economic worries, including stagflation risks, as higher energy costs can slow growth while pushing up inflation. At the same time, investors have sought refuge in safe haven assets like gold, U.S. treasuries, and the U.S. dollar, reflecting a flight from riskier equities. Equity markets, including the Dow and S&P 500, experienced sharp declines amid this risk-off sentiment. However, some sectors such as energy, defense, and utilities have outperformed due to expectations of increased spending and demand. The volatility is further amplified by the overbought condition of markets prior to the conflict, causing sharper reactions as traders recalibrate earnings, expectations amid slower consumer spending and geopolitical uncertainty. Historical patterns from previous Middle East conflicts show that markets typically react swiftly with initial sell-offs and a move into defensive assets, followed by eventual stabilization once the conflict's scope and duration become clearer. Yet, if the conflict persists or spreads regionally, markets could face further stress, potentially leading to additional equity declines. Investors remain cautious, balancing fear with disciplined strategies, as emotional reactions tend to underperform. Overall, the volatility reflects the complex interplay of geopolitical risk, energy market disruptions, inflation concerns, and investor psychology in an already fragile global economic environment.